Welcome to the debate on breaking news to trading moves. Usually, when we evaluate physical infrastructure, there is this expectation of, visible danger. Like you see a rickety wooden suspension bridge swaying over a canyon, and every single step you take is calculated.
Right, you hold the ropes tightly.
Exactly, you are acutely aware of gravity. But then you encounter a modern, steel-reinforced concrete overpass.
Yeah, it is smooth, well lit.
Right? It is universally approved by engineers. You do not even think about the drop below. You just accelerate.
It represents the absolute definition of structural certainty.
It really does. Yet in the financial markets, based on the material we are reviewing today, that exact feeling of certainty frequently becomes the exact precursor to portfolio damage.
Yeah, when a position looks completely secure, backed by a clean chart, robust earnings, or universal analyst approval.
Is it that the quote-unquote safe trade frequently becomes the most dangerous trade in an account? I will be arguing that this failure is an internal psychological breakdown, where comfort directly causes traders to abandon their discipline.
And I will be making the case that the danger is actually baked into the external market mechanics. A universally agreed upon setup possesses hidden objective structural perils.
Let us jump right into the psychology of this trap.
Sure.
From my vantage point, the illusion of safety is entirely a behavioral breakdown. It is built around comfort rather than objective risk evaluation.
How so?
Well, when you look at a well-known stock or a trend that has worked repeatedly, it acts almost as a psychological sedative. The human brain relies on heuristics, mental shortcuts.
Right.
Because the company feels familiar or the chart looks pristine, the brain conflates that familiarity with mathematical probability.
Even though none of those positive attributes actually remove the risk of the asset declining.
Exactly. But traders experience a false certainty. And the moment that certainty takes hold, traders give themselves permission to break the very rules designed to protect them.
You were talking about position sizing.
I am. A trader who mathematically strictly risks 1% of their capital will suddenly risk 2 or 3% simply because the opportunity feels unusually secure. The market did not force them to do that. Their own internal illusion of safety did.
I hear you blaming the trader's mindset, but you are ignoring the physical reality of the arena they are stepping into.
Oh, come on.
No, really. I do not buy that this is just a psychological failing. The behavior you describe is a symptom, but the disease is external.
External?
Yes. The true hazard is the market reality of consensus positioning. Think about the mechanics of supply and demand. A safe trade is, almost by definition, a crowded trade.
Well, sure, it is popular.
Right, and if a chart is undeniably clean and the earnings are uniformly praised, capital flows into that asset in a highly concentrated manner. That concentration alters the physical supply and demand dynamics of the order book.
Okay, but
if everyone believes an asset is going up, everyone has already bought. That means there is zero marginal buying pressure left to push the price higher.
I see the logic there, but that does not explain the catastrophic losses. A lack of buyers just means the stock stalls out. It does not mean it crashes.
Normal trade, because the exit door is only so wide. Let us use a physical analogy.
Okay, let us hear it.
A crowded trade is like a sold-out movie theater.
Right.
It does not matter how wide the aisles are. If someone yells fire and 500 people sprint for a door built for two, the architecture of the building becomes entirely irrelevant. The people at the back are going to get crushed.
Wow, okay, that is a vivid picture.
In the market, we call that a liquidity vacuum. The danger exists in the physical market mechanics of extended setups exposed to unforeseen news. The environment itself turns hostile.
That is a vivid picture, but let us look at the hand clicking the mouse. How do these two factors interact? Position sizing and market reversals.
They clash heavily.
Right. Let us examine the behavioral breakdown closely. A high-quality setup with poor position sizing routinely causes far more damage than a mediocre setup traded with strict risk control.
I agree with that.
If you have ever watched a perfect trade implode, you know exactly the feeling we are talking about. The confidence generated by the safe label makes you believe your tested plan is no longer necessary.
Because the environment looks flawless.
Right. But the environment looking flawless does not excuse reckless behavior. When the trade inevitably moves against them, traders do not just sit there. They actively choose to average down.
Sometimes.
More often than not, They look at the screen, the stock is down 5%, and their brain says it was a steal at $100, it is an absolute gift at 95. So they click buy. They consciously multiply their exposure during a drawdown. How can you blame the external architecture of the movie theater when the trader is actively choosing to run back inside the burning building to buy more popcorn?
Because the trader's reaction is forced by the velocity of the fire.
Is it though?
Yes. Look, I acknowledge the position sizing issue. Traders absolutely get overly aggressive. But when a trade is uniformly viewed as safe, the resulting price action when it fails bypasses standard risk controls entirely.
How so? If you have a stop, you have a stop.
Not in a liquidity vacuum. Let us say your trader kept their discipline. They sized correctly and they placed a standard stop-loss order at $95.
Okay. Textbook trade management.
Right. In a normal environment, the stock ticks down to 95. Their stop triggers into a market order. They sell to a waiting buyer and they take a manageable loss. But in a crowded trade, the sheer volume of consensus capital rushing for the exits creates that vacuum.
Ah, you are talking about the gap down.
Exactly. The stock does not trade down tick by tick. The highest bidder drops from $95 to $85 instantly, because there are literally no buyers in between. Your disciplined trader, who did everything right internally, still takes a massive hit because their $95 stop gets filled at $85. The external mechanics of a concentrated market neutralize their internal discipline.
But your reliance on the math assumes the trader actually lets the math play out? This brings us right to the core of trade management. Yes, slippage happens.
It is more than just slippage.
Fair. A gap down hurts, but if you size a position anticipating that a stop might slip, it does not destroy the account. What destroys the account is the evolving function of the stop loss in the mind of the trader.
Meaning what exactly?
When a position is oversized because of that illusion of safety, accepting a loss becomes psychologically excruciating. The trader's brain chemistry literally alters. A stop loss stops being a hard boundary and becomes a negotiation.
A negotiation with the market?
No, a negotiation with themselves. This is classic cognitive dissonance. The brain literally cannot process that a quote-unquote safe blue-chip stock is destroying the portfolio.
It causes immense psychological pain.
Exactly. So to resolve that pain, the brain fabricates a new narrative. The trader begins to treat the stop as optional.
Right, they watch the price approach their predetermined exit.
And suddenly, they dismiss negative news as temporary noise. They assume the broader market is simply overreacting. Because the trend has been so reliable historically, they refuse to take the loss.
So they intervene.
Yes, they physically go into their brokerage platform and cancel the stop order. What started as a precise, short-term tactical trade morphs into an unplanned, long-term investment.
Yeah, that happens a lot.
It is a purely internal failure. The market did not cancel the stop order. The trader's inability to admit they were wrong did.
Okay, I agree that canceling a stop is a failure of personal execution. But we have to look under the hood and ask why the market structure promotes that exact failure.
Go on.
In a widely accepted consensus trade, relying on a resting stop order is inherently flawed because the market structure is distorting. A stop is merely a resting order waiting for a price trigger.
Right.
But in an extended, crowded asset, the velocity of the unwind renders those boundaries highly ineffective due to cascading liquidations.
Okay, define that for the listener because people throw around the term liquidations loosely.
Gladly. Let us break it down step by step. When we say cascading liquidations, think of it like a domino effect in the order book.
Okay.
One trader's stop-loss order triggers a market sell. That market sell eats up the nearest bid, which pushes the price down just enough to trigger the next trader's stop-loss.
Creating a chain reaction?
Exactly. That creates a waterfall of automated selling that completely bypasses all logical pricing. You mentioned traders watching the price approach their exit and negotiating with themselves?
Right.
Often, in these consensus reversals, they do not get the luxury of watching it approach. Algorithms are programmed to front-run those obvious technical levels.
Because everyone placed their stop at the exact same moving average.
Precisely. If everyone is using the exact same clean chart, everyone places their emergency exit at the exact same structural support. And it gets worse when you factor in institutional positioning. If options dealers have sold a massive amount of put options to retail traders, and the stock starts dropping.
Those dealers have to short the underlying stock to hedge their own risk.
Yes, which adds literal fuel to the fire. The price blows right through the technical support levels. So while the trader's psychology is under pressure, it is the external distortion of liquidity and automated hedging that actually delivers the fatal blow to the portfolio.
That is an excellent breakdown of the mechanics, though I frame the takeaway entirely differently.
How so?
The rapid unwind you describe, the dealer hedging, the cascading liquidations, these are known market risks. We know the theater can catch fire.
Sure.
We know the exits can clog. Therefore, the severity of the damage is still governed by the trader's initial choices before they ever walked into the building.
But they cannot control the building.
No, but it is the combination of the illusion of safety, the inflated position size, and the refusal to accept the reality of the price action that ruins accounts. Which demands that we ask, how do we define and restore a truly controlled trade?
From the perspective of market mechanics, how do you see a trader regaining control when the environment is that hostile?
Well, the path to control is rooted purely in rigorous internal questioning. A controlled trade is not the one with the highest mathematical probability of winning.
Okay.
It is the one where the consequences of being wrong are clearly, strictly limited. Before a trader even enters the order, they must interrogate their own motives.
Ask themselves what exactly?
They must ask, how much of my account am I actually risking right now? And more importantly, am I increasing my standard position size because of objective new data or simply because I feel a sense of certainty?
Right.
The entire goal is building a robust internal process that prevents one single losing trade from inflicting unrecoverable damage. You treat your absolute best, most pristine setup with the exact same mechanical discipline as your most average setup.
That sounds rigid.
Control is an internal checklist.
See, internal checklists are fine, but they must be anchored to market reality. I approach it from the complete opposite direction.
Naturally.
The true path to control requires relentless external vigilance. A trader must look outward and ask, what specific price action or data point would definitively prove this thesis is wrong?
Which is what a stop loss does.
But they need to analyze the environment first by asking, is this trade crowded? Is the setup mathematically extended beyond historical norms? Are we seeing abnormal implied volatility?
But relying purely on reading the external structure assumes the market will always give you a clean signal.
Not necessarily a clean signal, just a factual one.
The illusion of safety works precisely because the external structure looks perfect right up until the moment it shatters. If your process relies on identifying when a trade becomes quote-unquote too crowded, you are dealing in highly subjective external metrics.
Subjective?
Yes. How do you measure consensus accurately before the trap springs? That is why the defense mechanism must be internal. You respect the stop regardless of whether the order book looks thick or thin.
Measuring external risk is not as subjective as you suggest. We have hard, quantifiable tools.
Like what?
We can track implied volatility. We can look at institutional positioning data and open interest in the options market. We can measure historical extensions from mean pricing.
Okay, those are metrics.
Ignoring those physical realities in favor of a rigid internal routine leaves a trader completely blind to systemic risks. Yes, treat every setup with discipline, but recognize that not all environments are created equal.
I am not saying they are.
But a pristine setup in a quiet market carries a completely different physical risk profile than that exact same setup in a market where everyone is uniformly positioned. The invalidation levels must adapt to the objective reality of the order flow.
We are circling a profound realization here. To summarize my stance, the illusion of safety is the ultimate behavioral trap.
Yeah.
It tempts individuals to abandon their proven risk rules, turning quiet confidence into dangerous certainty. That certainty leads to oversized positions and ignored stop losses, making the internal breakdown the primary catalyst for severe portfolio damage.
And my position remains that while personal discipline is necessary, consensus setups carry hidden, objective external risks.
Right.
The mechanics of crowded positioning, liquidity vacuums, and rapid algorithmic unwinds demand strict external vigilance. The danger is physically present in the market structure itself, waiting to be catalyzed by a sudden change in sentiment.
Yet, despite our opposing angles of approach, we converge on a vital unifying principle. No trade is entirely without risk.
Absolutely. The concept of a strictly safe trade is an operational myth. Some trades simply offer clearer invalidation levels and more favorable risk-to-reward profiles.
We also agree on the absolute necessity of the stop loss. A stop is not a prediction that the trade will fail.
No, it is a mandatory boundary.
Exactly. It is the mechanism that protects you when your thesis, no matter how universally supported, turns out to be incorrect.
Precisely. The safest mindset a trader can cultivate is not, this setup cannot fail.
Right? The proper mindset is, this can fail, and I already know exactly what I will do when it does.
Viewing market opportunities through both lenses, the lens of internal psychological discipline and the lens of external market mechanics, provides a much more comprehensive defensive posture.
There is a lot more to explore regarding risk-to-reward profiles and how we quantify these elements in real time, but we will leave the listener to evaluate their own approach to high-conviction trades today.
Indeed.
Think back to that perfectly engineered conically overpass we discussed at the beginning. It looks indestructible.
It feels entirely secure as you accelerate across it.
Exactly. But the next time you find yourself driving on it, entirely comfortable, not even thinking about the structure beneath you, ask yourself, are you still wearing your seatbelt?